Today we're talking about a top retirement strategy for longtime employees of Minneapolis-based Graco. Let's get going. Being locally based, I've had the opportunity to work with multiple clients that have spent at least part of their career at Graco. Now, a strategy that often comes up when we're talking retirement planning is known as net unrealized appreciation. Now, although I refer to this as a strategy, more technically it really refers to a somewhat arcane rule in the tax code that can be quite favorable for people that have two things going for them: highly appreciated stock inside of a retirement plan. And of course, it just so happens that longtime employees of Graco usually have both. Now, currently, Graco's 401k plan is administered by Empower. But if you've worked there long enough, chances are you participated in the company's ESOP program, or the Employee Stock Ownership Program. Now, the good news is Graco stock has been just a home run. I mean, maybe even a grand slam. If you take a look at the chart on the screen, look at this. It's just unbelievable. We're looking at a chart going back to 1990, and basically what this is showing in the blue line is a $10,000 investment back in 1990 would be worth almost $1.6 million today, and this doesn't even include dividends. So it's up over 150 times. And that, of course, compares to the Dow, which, not too shabby, is up 14 times by comparison, but it doesn't look like much relative to what Graco's done. Now, this massive appreciation is what puts folks at Graco that own stock within the retirement plan in a very good position to take advantage of this so-called net unrealized appreciation rule. Next, we're going to talk about how the NUA rule actually works. And it is somewhat technical. I'm going to try to simplify this as much as I possibly can. Before we get into that, I also just want to mention that Empower itself also provides some resources. So if you want to cross-check anything we discuss here today, reach out to them and they'll most likely send you a document that looks much like the one up on the screen. Now, to understand how the NUA rule works, we have to start by talking taxes. When you sell stock in a company, the way it's taxed depends on a number of factors, such as what is your income level and where is the stock actually held. Is it held inside of a retirement account or what I would call a non-retirement account? Now, it's easy to get lost in some of the details here, so let's start with a simple example to help explain. Now, for our hypothetical example, let's imagine Pat. He's age 62, worked at Graco for 30 years, and relatively recently he retired. Now, upon retirement, this is kind of what Pat's situation looked like. Within his Graco retirement plan, he had accumulated $1.8 million. Of that $1.8, $800,000 of that was in the ESOP plan, the Graco stock. So if we drop down here to the bottom, here's Pat's combined retirement accounts. $1 million in the 401k, $800,000 in the ESOP for the total. Now, in addition to that, over the years, when Pat had some extra money, he scooped up some additional Graco stock in a brokerage account that he set up independently on his own. Now, what I'm trying to emphasize here to help ultimately explain how the NUA rule works is these two categories of accounts are taxed differently. Next, let's get a little bit more into the details about how these two different types of accounts are taxed. Now, as a general rule, stock that is held over here in these non-retirement accounts get preferential tax treatment. Okay, they're subject to what we call capital gains tax rates. We're going to look at that in a moment. Generally speaking, money over here is going to be subject to regular tax rates, or what we call ordinary income tax rates. I don't want you to get too hung up on the jargon. All I really want you to understand is capital gains rates are generally more favorable than ordinary income rates. Next, let me show you the actual difference in the tax rates between capital gains and ordinary income. And just as a side note here, most of the money, if not all the money, within your Graco 401k and your ESOP, when you start to draw it out in retirement, is going to be taxable. Okay, now I just want to mention there can be some exceptions if you have any Roth money in there or after-tax money, which is kind of mixed in. Okay, that's not uncommon. I see that frequently, but generally speaking, the bulk of these dollars are pre-tax, which means they're fully taxable as the money is withdrawn. Now the question is, what tax rates are ultimately applicable to those retirement dollars as they come out? So right now we're talking about money coming out of the retirement plans that's taxable, those ordinary income rates. And if you look up at the screen here, in 2024, here are the marginal tax brackets. Okay, so it depends, of course, on your filing status. On the right-hand side here, we have the income brackets for married filers. And on the left-hand side, we have the income brackets for individuals. So for married filers, the first $23,000 of your income is hit at 10%. Once you get over that, income is taxed at 12%, and so on and so forth. My point here, the main thing I just want you to take away is the ordinary income tax rates in the tax code, depending on your filing status and your income, go from 10% all the way up to 37%. Now, just a moment ago, I mentioned that the tax rates for capital gains over here are generally much more favorable than those on ordinary income over here. Let's take a look at what those actually look like. So we already looked at ordinary income rates. Here are the tax brackets for long-term capital gains. And I should emphasize what long-term capital gains means is any Graco stock you've held outside of a company-sponsored plan, as long as you've held it for over a year, it gets this preferential tax treatment or so-called long-term capital gains. And also I really want to emphasize, I don't want to get too hung up on this, but take a look at the rates. In fact, the first tax bracket for joint filers goes all the way up to $94,050 is 0%. Okay, so if you had a bunch of Graco stock and you sold and realized the gain, if you had no other income, you could pay no federal income tax on that potentially, again, assuming you're a married filer, all the way up to $94,000. And frankly, it could actually be a little bit more than that because of deductions and so forth, but I don't want to get too into the weeds. All I really want to emphasize is the tax rates here, 0% up to a maximum of 20%, are more favorable than the rates on ordinary income. Now let's pivot back to our example with Pat. Imagine I've just had this conversation with him about the difference in tax rates on long-term capital gains versus ordinary income. Pat's going to be thinking, man, wouldn't it be nice if I could just get this stock that's in the ESOP over here? Because I'd way rather pay the tax rates on long-term capital gains than ordinary income. Well, this is where that net unrealized appreciation rule comes into play. It essentially provides us a mechanism for doing just that. Now, finally, let's talk about how the NUA rule actually works and why it can be so beneficial. We have to add one important fact to Pat's situation here. So we've already talked about him having $1.8 million in his combined retirement accounts, and $800,000 of that is the Graco stock, as illustrated here. The important fact we need to add is, what did he actually pay for this stock? And we're going to say, for example, it was $100,000. Therefore, another way to visualize this is Pat paid $100,000 for this stock, and he has $700,000 of growth on top of that for a total of $8,000. Now, this is an important distinction, which we'll see why in a moment. Now, first, let me just talk about, practically speaking, what NUA allows us to do. It allows us to do what we just were talking about. Move the stock from the ESOP to a non-retirement account, which of course would be subject to those much more favorable long-term capital gains tax rates, right? I think it's pretty clear for most people, that's a huge advantage. Now, there is a cost for doing this, and this is what's important to understand. What NUA allows us to do is it allows us to make that move, but the cost of doing that is we have to pay income tax just on the cost basis. All right, and this is why this strategy is so much more favorable for people with highly appreciated stock. In other words, the amount that they paid is relatively small in comparison to the total value. So in our example here, what Pat could do is pay the tax, the ordinary income tax, on the $100,000 of his cost. That would get all of the stock out of this retirement account, and the beauty of this is any future sales would be subject to those, again, much more favorable long-term capital gains tax rates. And additionally, those sales would be totally at Pat's discretion. He could hold the stock for 5, 10, 20 years, and he would not have to pay the tax on the gains until he ultimately decided, it was time to sell. Now, as you can see, depending on your circumstances, the NUA rule could provide some significant tax benefits. But the other thing I just want to mention here as we wrap this up, this is a relatively technical transaction. Okay, in our example with Pat and his $800,000 of Graco stock, in a worst case scenario, if he screwed something up, he could end up paying taxes on the entire $800,000. So you really want to make sure you get this right, work with a financial professional, work with a tax professional, and so forth. And in case it's not obvious, I do have firsthand experience helping clients with these transactions. So if you're looking for help or have some questions, please feel free to reach out to me. You can go to my website and send me a message directly through the contact page, or of course you can drop me a call. Anyway, just want to say thanks for watching today. This is a relatively technical subject. I hope we'll see you on the next one.